Although long-term buy and hold investing has many advantages, but there are also some potential pitfalls we need to consider as investors. Number one, market risk. Holding investment for a long period of time exposes the investor to the ups and downs of the market. The economy may not do very well. That will invariably affect your holdings in the market. Sometimes the market may undergo a level of crisis that equally will impact on your holding. Sometimes events like the pandemic, a black swan event of that nature will equally have an impact, though negatively, on an investor's portfolio. So the risk is always there if you are holding stocks for the long term, because the economy, we all know, doesn't perform well indefinitely. From time to time, that downturn should be expected, and when it happens, invariably it will have a negative impact on our long-term holdings. Number two, missed opportunities. When you're committed to buying stocks in some companies and you want to hold those stocks for the long run, for a long time, you want to hold them for almost indefinitely if possible, you discover that you are missing opportunities elsewhere. It's a kind of opportunity cost. Your investment is tied down, your money is tied down in some stocks of some companies in the market, and some other asset classes are doing very well. That's what we need to consider, as prospective long-term investors. We need to consider the opportunity cost that comes with the prospect of long-term investing. Number three, limited flexibility. When it comes to long-term investing, you're not as flexible as, let's say, a day trader. You don't just, buy and then sell almost immediately. No, you are investing for a very long time. It might be 5, it might be 10, it might be 15 years. And so you have that long-term horizon. And so you don't behave like, a typical momentum investor. You don't behave like a typical trader or a speculator. No. And so you are kind of limited in the flexibility when it comes to your decision to sell an asset at any given point in time. So you're not as nimble as other investors are. A particular investor was asked, I think Warren Buffett was asked why he did not sell the shares of Coca-Cola when they need to sell a roast. And he said, well, actually, I'm not nimble. That is, he cannot just, dispose his entire shares in Coca-Cola without affecting, the company stocks, or the company's valuation. And so you tend to you lack flexibility as a long-term buy and hold investor. Number four, psychological challenges. You will challenge psychologically because generally the market is volatile. You see your investment going down, and you're recording paper losses, and you can't do anything because you are committed to a long-term prospect of the company. So you don't just rush to sell because of a temporary negative occurrence in the market, or in the company stocks you are holding. You don't do that. And so you have to bear with the psychological pains and discomforts that comes with, this buy and hold strategy. It's parts and parcel of what is involved in being, an investor, that adopts this particular strategy. Number five, dividend cuts and business decline. You discover that sometimes the company can cut down on the amount it pays out as dividends when the company is not doing very well, or when the company needs cash to be able to fund its growth or to fund its expansion projects, fund R&D or whatsoever. It needs to propel the company forwards. economically. You discover that a company might be bound to cut dividends. And if business declines, the market is doing poorly, the economy is doing poorly, or the sector is doing poorly, you discover that the company, stocks will be affected. And as a long-term investor, this reality would really, down on you. Well, I think you have no choice. It's a strategy you're committed to, employing, and discipline demands that you hold on to your stocks. As long as those conditions are temporary, then I think it's necessary you hold on to your investments. Number 6, inflation risk. Inflation is something we cannot avoid. It's something you cannot run away from. Inflation is there year in, year out. And so inflation might eat into your investment returns. If you are not fully diversified or fully hedged against, you discover that the value of your holding may be affected by the rate of inflation in the economy. It's a disadvantage we need to consider when we want to adopt this strategy of buying and holding stocks for the long term. Inflation might eat into our overall portfolio performance. Number 7, neglecting rebalancing. Because we are committed to holding for the long term, we will be tempted to neglect rebalancing our portfolios, because you don't just rebalance like the way any other investor might do. Another investor might say, well, because of a quarterly loss, the person may be tempted to just, sell and buy something else. But as a long-term investor, you don't behave like that. And so you could end up neglecting portfolio rebalancing that is typically a very, very good strategy, as an investor, to be able to obtain the kind of return, the kind of yield, the kind of, money you want to make at the end of the day. And number 8, overconfidence in a specific stock, because for you to be able to hold the company for the long run, there's need for you to have confidence in that stock. And so from confidence, if it's not taken, it might result into overconfidence. The stock is doing poorly, you cannot sell because you feel and believe that it will recover eventually. Sometimes they do and sometimes they don't. And so you must avoid overconfidence in any given stock or in any given sector. And I would encourage we subscribe to this channel, like this video, comment on the comment section, and hit the notification button so I can keep on bringing similar content to you in due course. Number 9, tax implication. The tax laws will always change, although capital gain taxes are taxed at a lower rate compared to other forms of income, but all the same, we need to consider tax implication, as an individual that wants to, or as undertaking, to buy and hold stocks for the long term, because tax may eat into your portfolio. Whenever you sell, you may be tempted to sell prematurely to meet up with some pressing needs, and when you do that, you will be hit very hard by the tax regime. Number 10, opportunity cost. When you decide to invest for the long run, for the long term in a given company or in a group of companies, you discover that that particular action alone is depriving you from, spreading your capital to other asset classes. And on its own, it's an opportunity cost we need to consider as investors who are keen to adopt, or who have adopted this means or this strategy of investing. So it has its disadvantages I've just narrated. Although we should take encouragement, should be encouraged by people like investors like Warren Buffett. Is a typical long-term investor. Yeah, he held the stock of Coca-Cola for many decades, without selling, and many other companies like that, held their stocks for so long, and of course, he been able to derive huge benefit from that strategy he had adopted. The matter is just that it takes discipline, it takes courage, it takes, psychological strength to be able to hold onto your investments for the long term when the market is not favorable. So consider this particular, you know, consideration in mind, when you want to adopt this method, this strategy as an investor.